Good morning, you're watching Bloomberg Quint and I'm Alex Matthew. We're less than 2 weeks away from the end of the financial year, and what that means is that if you haven't paid the investment or made the investments that you need to make to save taxes yet, the countdown clock is running down. Now, having said that, saving taxes even with a handful of days remaining is still easier than scoring 36 runs in the last over of a 2020 cricket game, or if you're a football fan, scoring the decisive goal in the last minute of injury time. The bottom line is that it's not too late. In fact, it's really quite simple. Now, there are also a lot of you out there who've already done the heavy lifting for this year. We'll also discuss what you need to do to stay ahead of the curve with regard to tax planning in the year starting April. Joining me today to get all of your doubts cleared are two experts, both certified financial planners, Karthik Javeri and Arvind Rao. Thank you so much, gentlemen, for joining me on this conversation. I think there's a lot to discuss today, both of you, gentlemen. I think it is important to note what the rules stand for FY19, which is the current financial year, and the changes that were announced in the budget. But before we do all of that, I think it's important to talk about one major misconception, Karthik, which is how is tax really computed? Because a lot of people I've interacted with have this misconception that if they're earning 8 lakh rupees or if their taxable income is 8 lakh rupees, they think their tax payout is 20% of the total 8 lakh, which is a lot of money. But it's not, thankfully, it's not like that.
It's not like that, because if it was like that, then the finance minister and the government of India would be super happy, because if you were volunteering and making a charitable contribution of your taxation. But so what happens is, whatever is your income, basically, you have a whole range and variety of deductions.
Yes.
So from whatever you earn, you deduct everything that is allowable as a deduction, and after that, whatever is left with you is then therefore offered to taxation, which is known as your taxable income, and then those various income tax slabs are applied to it, and thereafter your income tax is computed. So from a last year's point of view, technically almost 8.5 lakhs should be going away straight away if you did all the investments, if you had the housing loan and all of that. If you had all this deduction as a packet, then you won't really have to pay anything. But the simplest one is your ATC deduction, which is 1,50,000. If you want to go ahead and do a NPS deduction, then you have an additional 50,000 there. If you've got a home loan, then you've got 2 lakhs. That's the maximum allowable deduction. If you've got a medical insurance, which you're paying for, and which I think all of you should do, #1 priority in life, and you get a deduction up to a maximum of 25,000. But don't stay with that. If your need for medical insurance is higher, please go higher. But otherwise, that's there. If you're paying for your parents, you have that. And standard deduction, the easiest one of all, that's another 40,000. So if you put all these goodies together, there's quite a packet that you can actually save. And with 8 lakhs, you can actually walk away without tax.
So assume, however, that after making all of those deductions, you're coming to around 13 lakh rupees. Right? We've got a case study, haven't we? So approximately 13 lakh rupees is your taxable income after all of the deductions. What happens is that in the first slab, which is the 0 to 2.5 lakh rupees, you pay no tax. In the second slab, which is 2.5 to 5 lakh rupees, you pay 5%, which is 12,500 rupees. In the next slab, which is the income above 5 lakh and less than 10 lakh, you pay 20%, which is 1 lakh. And in the last slab, which is above 10 lakh rupees, you pay 30%, which in this instance is 90,000. And that brings your total tax payout to 2.02. And you also pay a cess, remember. That 4% cess has to be added onto that tax that you pay. So that's how it stands as of now, gentlemen. Where, like I said, about 2 weeks away, and I said, look, you gotta prove it to them, Arvind. It's not as difficult as scoring 36 runs in the last over of a T20. It can be done.
It can be done. I think at the end of the day, it just boils down to how much of cash is one actually left, because practically what we observe is for most salaried taxpayers, Jan, Feb and March happens to be the month in which most companies request for the declarations and the proofs. And once they are not submitted there is more of tax deduction. So virtually this quarter is when people are used to getting lesser amounts in hand. So that's the challenge. While making investments is very easy, but getting the money in hand as of now to make that investment is where the million-dollar question is how do you do it?
So here's another bit of not a misconception, but what people don't really realize when they get the cash in hand. The gross salary and what you get in hand is very different.
Absolutely.
And that tax payout happens every month, right?
Yes.
So if you haven't made the declarations at the start of the year,
Yes.
your employer assumes that you're not going to make those investments,
Yes.
and therefore a certain amount of tax gets cut every month.
Yes.
Now, if you decide in the last month of the year, on the last 10 days of the year, obviously the tax has already been cut for the rest of the year.
Yes.
So what you have to do to save that tax is to make or try to get a refund.
Absolutely. Right? I mean, the people who are already late, so all they can do now is they can still make that investment, but the catch here would be that whatever is the excess tax that has got deducted because of your last minute decision can only be claimed by filing your returns and claiming the refund. Well, with all the e-filing processes now streamlined, even claiming a refund is really not a botheration, because even last year when you observe that an average time span for claiming the refund was like around 2 months to 3 months. Provided it's a reasonable sum. Higher amounts of refunds have taken slightly higher amount of time, but it's definitely a big improvement from the times when you had to struggle for getting the refunds.
Okay, I believe we've got our first question of the day. Sumit is asking a question: are the changes made in the budget applicable this year? I think that question got addressed right at the start, and this is something that a lot of people are, because it had to do with some of the announcements really that were made either during the budget speech or just after, where the finance minister made certain statements.
You know, so it's a tradition that we have our budget in February. But and every time we try and explain this thing, that the budget has provisions which are being tabled in the parliament. They have to get ratified by both houses, and then the finance bill has to pass, which happens by about May and June, and therefore it's applicable always next year. However, the confusion happens because, for example, things like petrol, diesel prices are made immediate effect. Changes are brought in with an immediate effect, and that confuses people. So once again, to clarify for everybody, whatever was announced in the budget is applicable for the forthcoming year,
and
not
that
this
too,
year.
it's also important to note that this was an interim budget.
Yes, absolutely.
And the new government that will come in will obviously have to ratify all the changes that have been made and pass all of them. And therefore, we'll come to that in just a short while. We will also discuss the changes that were made and how you should plan your finances. But before we do, let's take another question. I believe Darshan Jain has got a question. How do I avail of the tax benefit under Section 80G of the Income Tax Act? Do we have an answer for him?
Yes. So 80G, Darshan, is primarily the deduction that comes along when you strike the charitable side of your profile. So if you make donations which qualify under 80G, so let me just take a half a minute here to say what are the when does a donation qualify under 80G is, you have to take note whether the institution or the organization to whom you are making a donation has taken the requisite certifications to be allowed to give the donors a deduction under 80G. How do you get this to see is very simple. Insist on getting a receipt, and on the receipt at the bottom side you will see one line saying that this donation qualifies under 80G. Some of the institutions also attach a huge 80G certificate. Just a small point here, Alex, that I would like to make is, which many donors generally ignore. All of these 80G certificates that are granted by the department to these institutions are always time bound. So each certificate comes with a validity. So when you make the donation, please ensure to see whether the 80G deduction for the institution is valid for the current financial year, or else your deduction might be denied by the taxman during assessment.
Okay, that's a very important clarification there. We're joined, of course, by a lot of people online as well, and we'll take some of those questions while they come in. But, you know, I think it's a good point now that we've spoken about what you can do, and I think we covered that, right? You can do 80C, whatever is left over above the Provident Fund, you can make either ELSS contributions, which is equity-linked savings schemes, a 5-year fixed deposit. What are the other, very quickly, what are the other options
School
that you
fees.
Can make? Okay.
You have bank fixed deposits as well. You have life insurance premiums.
Right.
I think these generally take up the major
chunk of it.
And also health insurance, like you said, for the
which
parent.
qualifies under a separate section called ATD, which you can do 25,000 for yourself, and if you're paying for dependent parents, or if you're paying for your parents basically, then you can take an additional deduction of 30,000.
Then there's also the national pension scheme, which you can do
an
both
additional
in
50.
ATC as well as over and above.
No. The national pension scheme is over and above ATC.
I know. So you can do ATC plus over and above
scheme.
50,000 you can do. Right. So those are broadly.
There would be one more. If I mean, for all those early people in their early careers who might have taken an education loan, so don't forget to claim the interest that you are paying on an education loan. That's a separate deduction under ATE. And the good news here is there is no limit on the interest claim. Whatever is the interest you pay, you can claim the entire amount.
Yes.
Okay. All right. So I think at this point, it would be interesting really to segue into what was announced in the interim budget by the Finance Minister Piyush Goyal. He essentially talked about one major change, and there's a lot of confusion there as well, because people think that there's a change in the tax slabs, which isn't the case. The tax slabs remain the same.
Absolutely.
What has changed, gentlemen? It's effectively if you earn less than 5 lakh rupees of taxable income,
net taxable income,
after all of the deductions, you get a rebate on the tax. So how is there a difference in the two?
I think this will be best understood if we compare what it is for this year and what it will be for the next year. Currently, the rebate, the way it works is if you have income between 2.5 lakh to 3.5 lakh, then on that income, if the tax comes out to around 2,500 rupees, and the section 87A, which offers this rebate, says that if your income is below 5 lakhs and if your income is below 3.5 lakhs, this 2,500 is exempt because you get a rebate. Now, the current, the last interim budget actually extended this rebate from 2,500 to practically 12,500, with the condition remaining the same, that as long as your net taxable income is below 5 lakhs, whatever is the resulting tax will be, you are eligible to claim a rebate on that. So, all those people who jumped on seeing the news flashes saying that income up to 5 lakh is exempt, I believe the minister was pretty clear in his speech when he said that it is a rebate which has got enhanced from 2,500 to 12,500.
Okay, that's fair. So what that essentially means is that mathematically, at least, guys, if you're earning about 9.75 to 10 lakh, so in that sense, listing out all the available deductions, 2 lakhs for the home loan interest that you pay.
Correct.
You have 1.5 lakh for ATC, 50,000 over and above that for ATD, which is National Pension Scheme. You also have 50,000 for the standard deduction. You put all of those, health insurance premium, all of that together, you can reach 5 lakh rupees. But while that's mathematically possible, gentlemen, it might just be a little difficult to put into practice in reality.
Everyone.
Because if you're talking about 2 lakhs of interest payment on a home loan,
not everybody is
effectively that means your home loan is about 23-24 lakh rupees.
Outstanding principal as of today, yes.
Is about that much.
But everybody can go up to 7 lakhs. That's easy.
7 lakhs.
Because 7 lakhs will give you 1.5 lakh of deduction under ATC and 50,000 a standard deduction. So in that sense, anybody and everybody up to 7 lakhs will get this 2 lakh deduction, because this is easy to do. Everybody has to do some investment, right? Whether you're buying an LIC policy or it's a policy from a private company or a ULIP policy or an ELSS or any of these things that you're doing. So take away the 2 lakhs, standard deduction of 50,000 and ELSS or ATC of 1.5 lakhs, which puts you at 5 lakhs, and therefore you can enjoy your entire 5 lakhs without tax.
So, okay, before we go forward, I just want to take a live query, and we'll come back to that conversation, because I have a very important question that I think a lot of people have. Akshay is asking whether he can claim health expense or family health expense even after taking the benefit of the standard deduction. And I think that's, it's obviously changing. Last year, the standard deduction available was 40,000. This year, it has been increased, or it will be increased in FY20 to 50,000 rupees. And this standard deduction, Akshay, was made in lieu of health or medical expenses, and transport, if I'm not mistaken.
Absolutely.
Right?
So it was all combined together and made into a composite 40,000.
Yeah.
So you don't have an additional benefit. It's all rolled into that 40,000 and going forward 50,000.
And you don't have to provide any proofs for that.
Nothing,
it's a standard deduction that is available.
Yeah.
Earlier it used to be 34,200 if I'm not mistaken, and the year before that, and it was raised to 40,000. Next year it'll be even more. It'll be 50,000. All right. So coming back, so hopefully that answered your question, Akshay. Coming back to the point where you're making investments to save tax, where do you draw the line? Because tax saving investments, while they are good in principle to save tax, when you're talking about pure play investment products, both of you advise on people's long-term goals, where do they draw the line? Should they prioritize their goals rather than tax? And how do they go about it then?
I think a good idea is to roll 2-3 things into one particular objective, right? So whenever we are making an investment, the first thing is obviously merit of investment. But before you even make an investment, the why of an investment. Why are you making an investment? So when you answer that question, why am I doing this investment? The first thing you're doing an investment is for some objective, some goal in life. So within that goal, let's say the goal is education for your children or retirement for yourself. That's a long-term goal. That's one goal which is sacrosanct. Now, as a part of that goal, you have to make some investment. Within that investment, can you get a tax benefit? And then if the answer is yes, you go ahead and take your tax benefit. So if you need to, for example, invest 5 lakhs towards your retirement every year, out of that 5 lakhs, 1.5 lakh could go into one of these tax saving products, and the other 3.5 could go into other products which don't give you tax deduction but still augment your retirement planning goal. So in that sense, goal is right at the top, okay, and the tax saving and the tax planning, so to say, would be inbuilt or wrapped within that larger goal of your life.
So to put things simply, if we're talking about whether or not to make a certain investment for the purposes of saving tax, if you're talking about our earlier example of 9 lakh rupees, and you've made all of those tax saving investments and you've come to about 5 lakh rupees, you're left with approximately 41,500 rupees per month. And from that, you have to make your long-term investments. So you're really not left with anything.
Absolutely.
To invest
you can't
for the
have everything. These are provisions that are available. Please use it if you need to. And otherwise, the government has been very generous to say that. And see, a large percentage, almost as much as 60% of the population is actually covered because, I mean, the tax filing population, so to say, not really the whole population.
Which is a
reasonably small
amount.
But out of that, the 60% returns that come in, or almost 60 to, I would even hazard a guess of almost about 70-75% return, are below 10 lakhs. So that means the large majority of working population who's earning money have a lot to benefit from.
Okay, fair enough. Okay, so at this stage, let's look at then what you can do for next financial year, assuming that all of the things that have been announced in this interim budget are actually ratified and put forward. You have to obviously start ideally saving or planning in April itself.
Absolutely.
Stay ahead of the curve, make the declarations that you need to make.
Yeah.
If you're staying on rent, of course, you can declare that as well, because most people forget about it.
Yeah.
So what are the, the tick marks that people, or boxes that people need to tick at the start of the year?
I think my first generally advice here is they need to first check their box in terms of what is the total provident fund deduction that goes. Because many people tend to ignore that they are already contributing something that's getting deducted from their salary. So PF comes first. Next, let's look at the expenditure that you are going to do, which also gives you a tax deduction. The best example of which is your school fees. So most probably parents are generally paying up the fees in April and I guess September. So you know what these your fees are, take that. That's the second checkbox. Third is, like Karthik said, Mediclaim premiums, or even for that matter, life insurance premiums. Most probably people, I think the odds are as high as 8 to 9 out of 10 people definitely have some insurance premiums. So take this tally. Why I'm stressing on this fact is generally in our experience in these 3 brackets itself, the 1.5 lakh limit gets covered because I mean, once that is done, you really don't have to spend time to see what else you need to do. Generally, this whole tax planning thing or the ATC thing runs on people's mind, and they tend to forget that I have already exceeded this.
Yes.
So take a stock of that, which you can do probably by the 15th of April. And once you know that, you are either know that you are already over the quota, or if you fall short, you have at least 12 months to kind of break that up so that you're not strangled at the last moment at how do I get this money across.
So essentially telling your HR team or your HR representative, these are the declarations. So assuming that
Yes.
you're short of about 60,000 rupees out of that 1.5 lakh,
Yes.
then you say that you're going to make these investments. You don't need to necessarily tell them where you're going to make those
Yeah.
investments. You declare at the start.
As a matter of fact, you need to tell
Oh,
them, but that's not like held to ransom.
Ah.
You may say that I'm
You
going
change.
to do something, and by the end of the day, you do something else is fine.
Right.
In fact, I would like to add something more to what Karthik mentioned about when you're making the decision of whether to invest for the purpose of tax saving versus not. In these cases, we have got ample cases where people are struggling because the moment you talk about a tax saving investment, the minimum period that it gets locked for is like 3 years.
Yes.
And if someone is really struggling to meet the short term goals, tax saving really doesn't help because it's like parked away for minimum 3. So then what you need to do is check what is your shortfall that comes in, translate it. Now, for example, let me give an example. 40,000, let's say, is the shortfall in your ATC deduction. On 40,000, if you happen to be in the 20% bracket, it means 8,000 is your tax liability that you would be paying if you don't do this 40,000 investment. Divide that 8,000 by 12 and you get a figure like, I think, some 750 rupees a month. If you feel 750 I'm okay to give as a tax rather than parking away 40,000, so be it.
So it's a decision that you take at the start of the year, but it's a
Yes.
good practice to actually look at what your tax liabilities will be.
Yes.
And the first thing obviously to do is to check how much your contribution to PF is. I very quickly want to take our viewers through perhaps one of the doubts that they might have, considering that this is Bloomberg Quint. I'm sure a lot of our viewers are interested in investing in the markets, the equity markets. How do they look at LTCG on equity? Obviously, it's not coming in the purview of income tax per se.
Sure.
But how do they plan their investments, considering that it kicks in more or less from this year? Because that grandfathering effect from last year or the year before that, it's more or less enough time has passed for that to really kick in.
Sort of, yes, because 31st January was the grandfathering date. Then the markets corrected in the last quarters of the previous year, previous calendar year. So now it's kind of coming back, and going forward is where your capital gains will, I think, largely start ticking in. So it's going to be 10% from the year going forward, yeah.
Okay. All right. So, well, that's pretty much how it stands currently. Hopefully, this conversation with Arvind and Mr. Javeri here, Karthik, has helped you to make the decisions that you need to make both this year as well as next year. If you have any more queries, you can always send them in to us on any of our social media platforms, or you can even write into us on portfolio@bloombergquint.com. If you have any financial goals that you need help with, you can also send your queries to us, and either one of these two gentlemen or somebody else will help you fix up your goal as well. That's all we have for you in this edition of Bloomberg Quint's Portfolio.